So basically, treasury markets, bond markets yields have been relatively volatile. We've seen huge moves between last week and this week in terms of on a daily basis, the 10-year moving by 10, 15 basis points, sometimes 20 basis points intraday is quite exceptional. It means that there are some movements underneath the surface or beneath the surface that where you've got some people who are short enough to cover those short positions, and some people who may want to start taking long positions. But overall, at least the curve in the US has started to trade into a range, so we could be closer to maybe peak rates at least on that side of the curve. The key unknown for the moment is how much or how aggressive the Fed will be to fully flatten and invert the front end of the curve. But for the rest, we might be actually indeed, to your point, we might have seen the worst of the sell-off in the very long end of the curve, which has been impacting high growth stocks, tech and internet retailers and others.
Antoine, let me ask you about the recession trade, because already we're seeing some concerns about how this plays out internationally. The won is the latest casualty today, as we've seen it test some of the lows not seen for 14 years. How does this manifest itself in terms of fund flows internationally as these recession fears grow?
So first things from an international standpoint is that investors have been relatively staying away from EM, whether it's through fund flows that we observe via the ETF market, but also when you look at the IIF flows, so International Institute for Finance flows, which look at financial direct investments into those countries. So that is definitely having an impact on emerging markets and markets which are linked to this growth. That is also linked to the fact that there is a reduction of overall liquidity available. So this is clearly taking a toll on some of those countries. Definitely, the current one, as a big exporting nation, could be impacted should a recession be global, and definitely impact consumers in particular. And that's a kind of things we're waiting to see. Obviously, PMI numbers still are positive. They're slowing, but they're still in expansion mode. So the key question is, how much damage this tightening of financial conditions will be making to the rest.
I want to also move on to yields, because you captured my attention with a debate over whether we're at peak yields at this point, which does take us to the conversation as to whether we've got markets moving ahead of central banks at this point, and now whether we're at those peak levels. What do you think? Because some still think we might be early days in some of this tightening we're witnessing so far.
So the tightening is going to be very much impacting the front end, and the key moment is where we pivot and how it impacts the overall long-term growth expectations. That's why I was mentioning the 10-year. The 10-year has been moving from say 3.45 and 3.10 over the past few days. That's quite a massive move to some extent in terms of volatility, but on a daily basis, but touching 345 and going close to 350, which is where we were probably at the end of the previous cycle in 2020 and 2018. Maybe there's a bit more room. It will really depend on inflation and how inflation expectations are anchored. For the moment, if you believe that the Fed and other central banks are going to tighten conditions that actually push the economy into recession, probably the intermediate to long end starts to be relatively well priced. But, and that is the key question we're all having to grapple with, and that's what we're looking into our real-time inflation data that our colleagues from State Street Global Markets, together with PriceStat, are actually providing us. Is this kind of real-time inflation remains relatively hot, and that is a challenge for being able to anchor inflation. We're looking at one of those. I think this week we've got the University of Michigan expectation of inflation for the next 5 to 10 years, and we've seen that they have gradually risen over the past 12 months now, and they're close to the level that we were back at the peak of 2008. So clearly, there is we have to see a stop in or at least a flattening of this expectation of higher inflation, because that could happen. That could be basically the way that I'm expressing is the long end could be more stable going forward, only if those inflation expectations are sufficiently anchored.